time in the market is more important than timing the market. This is what people like Warren Buffett say, right? They say you simply have to be allocated for a very long time in the market. You don't try to ride those waves. You don't try to buy low and sell high and buy low again. You simply just have to be allocated for a long time. Time in the market beats timing the market. But I tend to disagree. I tend to disagree for several reasons. Because the first reason is people assume with those kinds of sayings that the market is already pretty efficient. And for some markets, this might be right. Some markets might be very efficient. For example, the large stock markets, or let's say the currency markets, right? There are so many people that think about stock valuations. There are so many very advanced quants that trade those very sophisticated markets, that getting out an inefficiency in those markets and beating the market is very, very hard. So for the small minority of people that know how to play the game, for them timing the market might work. But for the vast majority, time in the market is way more important. As in, you simply just let fiat currency devalue over time and you make money in holding something that appreciates over the ever-expanding fiat supply. So I agree with this. But it is, again, a generalization. And the problem is, you can't think about investing too simplistic, at least if you want to get ahead to a degree. So this timing the market is inferior to time in the market is not necessarily true for markets that are not yet that efficient. And so markets over time, I believe, become more and more efficient as history goes on, as people learn more about the market, right? If you looked at the very early .com companies, and you look at this massive boom and bust, would it really be the right decision to simply just have a lot of time in the market? For the vast majority of stocks that you bought during the .com bubble, you would have lost pretty much all your money. If you bet on the one or two outliers that made positive returns, then of course you would become rich, right? Like if you bought Amazon during the .com bubble, that would have been a nice bet. But for the vast majority of stocks, it would have been a terrible idea to simply just go along with the market, to simply just be in the market for a long time. So the people that timed the market, that timed the euphoria, for the people that tried to ride the waves, that tried to exit when everybody got excited, they were the ones that made most money. So I believe there are probably more people that simply made money by timing that market than the people that bought Amazon stock, right? Simply because the investment universe is so big. So what you want to look out for is you want to check, do you want to beat a market? That should be the very first question. And you can answer that question by thinking about, will you be able to be among the top investors in that market? Because beating the market simply means that you can estimate the lows and the highs better than the average. And usually the few winners that beat the market don't just beat it marginally, they tend to beat it very, very massively, right? The winner takes most. So once you understand the market, once you understand pricing, once you understand momentum, then you can simply just rinse and repeat, and you will accumulate more and more capital over time. And so you would suck out more and more profit out of that market. And so there's a few people that make a lot of gains, but the longer a market matures, the smaller that fraction of people that are winners becomes relative to the overall market. So at the beginning, everything is inefficient. Nobody really knows how to price the asset. Nobody really knows where the journey will go. But once you go longer in duration, right, once the market develops, that thing changes. And so you have to ask yourself, will you be among the top investors in a certain market? If you now start currency trading, it's very likely that you have to answer this with no, unless you have very, very smart people next to you, right? Unless you know hedge funds that consistently beat the currency market, that use all kinds of second and third order option pricing models. Maybe you can beat the market that way. But what I think is the better approach is to simply just look at the young markets, right? Look at the markets that aren't yet that developed, where nobody is skilled, where you don't have to beat somebody that has already figured it out. You want to be in the markets that are growing, so that attract a lot of capital, but at the same time where the skill isn't yet that developed. And then you need to be among the few people that spend way more time in that market than the average. You need to be among the top 10% at least. This is how you beat the market. This is how time in the market is not more important than timing the market. You can time the market if you have inefficient markets, if you are better informed than the average. And this works easier the more inefficient a market is. Now, why does this work, for example, for crypto? Because it's very young, because you've got a lot of data as well. Right? If you know how to use the blockchain data, you can definitely beat the crypto market. You can track all kinds of wallets. That's what we are doing in the premium membership, so feel free to check that out. You can also beat the market, for example, in property, right? Because property is also a very heterogeneous market, as in you can't buy the exact same house several times. So you can't really scale it up. And because it's very hard to scale property trading, the market isn't that efficient. And so if you know a lot about your area, about your property area, about your town, about the developments in your town, if you know a lot what's going on, then you might be able to estimate the value of a property better than somebody that had already 10 years of experience. Simply because property A can be very different from property B. If you can distinguish that, then you have an edge. It's very different to, for example, the stock market, right? Every stock is completely fungible. So a lot of people say that there's some kind of a risk to return spectrum, right? If you want to get high returns, you have to take on a lot of risk. If you don't take that much risk, then you get lower returns. But I believe that's actually also somewhat misguided, because risk is simply just the unknowns, right? Risk is, for example, if you don't know the weather. If you're a farmer, you can't know what the weather will be in this season, and of course you do have risk. But there are other factors that also impact return that might be random to others, but not necessarily random to you, simply because you know more. So let's say, again, you're that farmer and you made a lot of research and you found out for that specific soil, I should be using that specific crop, and I made my analysis on the overall market in the world that specific crop will be in high demand and that there's not so much supply. You simply just made a lot of research on what you're actually going to use your farm for. And you actually know exactly how much you should be expecting to get out of your work. Now, that being said, you will still have this random element in it, right? You still don't know the weather. But over long enough of a time frame, right, over many, many years, you're likely going to beat the farmer that simply just randomly allocates to something, that simply just randomly follows what all the other friends are doing. Right? And it's the same for any other market. The more knowledge edge you have, the less important the luck component becomes. There's always a luck component, but the longer you play the game, the less important it does become. And so what might be a constant risk to reward ratio for the average Joe that doesn't make much research is very different to the person that does do the research. The more research you do, the more you reduce the risk potentially while keeping the reward up. So you want to reduce risk by knowing more, and you want to obviously still take the reward that comes with that specific asset. That's how you improve risk to reward in investing. You simply have to be better than the average. And yes, you can time the market if you are among the few people that actually put in the effort. So if you're willing to put in the effort, if you're willing to become part of the people that actually beat the market, that don't just follow the random sheep, then feel free to join us in Telegram. It's free. The link is down below. See you over there. And please give this also a like, and see you in the next video. Cheers.